series, Invest Your Way to Financial Freedom. Today is May the 3rd, 2026. This is our 10th video, guys, about this series. Definitely, we are deep into the series. If you haven't seen our series yet, make sure you log in YouTube and ElBozoBonsando so you can follow through with the series. We already talked about a lot of information to this series, and I'm glad this is the 10th video. After 2 weeks of vacation, we are back accomplishing the mission of, definitely helping build the next generation of investors. So, as I mentioned, we are definitely excited to be here today. Um, this is your series, Invest Your Way to Financial Freedom, where we use a simple investment framework based on maximizing your income while you reducing your expenses. And part of that, you're gonna get what we call the net income. And if it's positive, you can use part of it to invest in liquid asset like stock, bonds, and also part of it you can combine it with positive debt, so you can do invest in illiquid asset like real estate. So I am your boss. I am your host, Elboso from Comic Group. Our mission is simple. We want to simplify the business and investment world so you can be more educated financially, so you can invest your way to financial freedom. We want to inspire the next generation of investors so they can take your journey to the next level. This is no hype, realistic strategy. Make sure you like, subscribe, follow us at ElBozoBonsando and all social media. And if you join us, we welcome you in this series. If you haven't seen the full series, guys, this is our 10th video, like I mentioned. Go back and watch those videos, subscribe and like. We do this because not because we want the hype, not because we're trying to be a social media famous. It's all about the people out there. I've been there. I've been in a situation where I was frustrated with my life, thinking just having a job, so-called good job, well, I will get away with it in life. But I realized, wealthy people, they don't just count on a job, they invest. And this is when I become an investor, start investing in myself, building myself as far as, educating myself. And that's why I'm trying to do in this series, to give you guys the information that you can use and take your investment journey to the next level. Things are getting worse. I'm sorry, I'm not trying to be the bad guy, but things are getting worse, guys. If you're not investing, guys, if you just count on a simple job, I'm telling you, you're not gonna make it. It's all about, it's just like it's time. So inflation gonna eat all your money. The little money you're gonna have in reserves, if you don't invest it, if you don't really focus on investing it, you're not gonna get by. See, that's why this series is about, take, like I always say, rich people are not smart. They just smart everybody out. And you're gonna smart them out yourself by educating yourself. So let's go deep into it. As usual, we're gonna start. We give you guys what happened this week. We will do a quick summary, some intake, and also we tell you, what we think about market that's coming up next week, what we're paying attention to as investors. We also discussed like a tweet best stock that's worked for our portfolio this past week. And we also talk about the main topic, which is today's what are bonds and how to invest in bonds. So definitely, this is an interesting topic for especially for smart investors who are not just chasing the hype, who are just looking for a safer, I will say, a safer option for their investment, especially if you're older. If you're not really into taking too much risk in the market, if you like older, you might want to look at in bonds more, as you go along, as you diversifying your portfolio. So like I say, for this past week, the big news again is the war. The war between U.S. and Iran and Israel. This war is dragging. I don't think there's a clear exit. So, and you can see that, because of the war, you see a lot of inflation going on, oil price spiking. It was 102 day today, I think. The average the average gas, a gallon of gas in the US is about $3.34. So inflation risk is still remain. It's a big pressure on interest rate. So definitely we are looking to see what's going on, from what's happened last week. And technically I think the oil price, it might go up. So that's when inflation come in. Next this week coming up, I don't think there's too much going on as far as changing the course of the war, unless something big drastic, some peace deal, a long term happen. Because as you can see, the oil price is going up and down. So make sure. But guess what? As we mentioned, it could be a good thing, because when oil prices are going down, we are investing in oil gas stock. So we taking advantage of that. So don't think like because of inflation and short term, you got to make sure you understand. You got to take advantage of those oil prices fluctuation. So the latest update suggests that rising uncertainty and potential military and economic decision ahead. We don't know yet what's going to come up with the Trump administration, but the main impact, that energy stocks going to be up, airline transportation going to be down, especially, as we see this weekend. Yesterday, Saturday, you got Spirit Airline already top out. We're going to talk about it in a few minutes, how all the gas oil and price gonna affect the airline companies. But that's also a signal that volatility, we're gonna expect a lot of volatility for the next week coming up. And we got to be paying attention to that. So yeah, definitely, when you see like oil prices going crazy high, the airline companies are suffering. And a great example was this week, yesterday, Saturday. For example, my experience, I was coming from Miami to Chicago, and guess what? Spirit Airline at 2 a.m. My flight was at 7 a.m. And they sent me a notice that, guess what? The company went bankruptcy. And I was shocked, despite, a lot of speculation that the Trump administration was going to help the airline company. But it happened, that Spirit have to tap out. And I can tell you, the Spirit Airline shutdown will have a negative impact on investors, especially for the border airline sectors. It's highlight how vulnerable highly leveraged airlines are to fuel spike. I think the oil prices kind of make it worse for Spirit, so they have to tap out, and that's gonna happen for a lot of airline. But at the same time, short term, you're gonna see temporarily benefits competitors like Delta, United Software. Those might have a better balance sheet. They might have to address better risk adjustment for them. So short term, those companies stock might go up, but potentially improving pricing power and margin in the short term. So those companies will have less competition, especially for the low competition for the low class airline. So, however, it's all also reinforcing investors' caution toward airlines as a cyclical, high cost industry where external shocks can quickly wipe up equity. So, definitely, if you are investing in an airline stock, guys, I will suggest that's something you want to pay attention to coming into next week. Uh, in general, you see overall this week we see the S&P 500 going up 27%, guys. So the AI team still remain dominating the market. The tech companies, they were like definitely looking into dominating the market. But again, inflation remain a problem. From we have inflation rise to 3.5% above Fed target. Gas prices going crazy. And this past week on February 29th, which is I think on Thursday and Wednesday, if I'm not mistaken, the federal government had to put the rate in change, you know, because they are not sure what's going to happen in the next few weeks. So in midst of the uncertainty, they just stay the interest rate will stay and change. So this is something like we are paying attention. Official warning inflation may stay high. So market want rate cut, but the Fed might delay even hike again if inflation worsen. So that's the concern for investor right now. We don't want the inflation to go out of control, because guess what? It will force the Fed to even hiking, put the inflation rate down to cool off more the economy, which is already broken. So a lot of uncertainty going on, guys, in the market right now. So just pay attention to that. And technically, for next week, for example, we look at for next week, for example, a especially on Monday, tomorrow, we have a Jones William, which is the Federal Bank of Atlanta, the Fed speaker. So he's the one. He will talk about market and all those outlook. Usually, the Fed Atlanta from Atlanta, a market will listen for a hunt about interest rate and inflation outlook. So we're gonna pay attention to those people, guys. If you're into business, if you are into the investing community, you're paying attention to those people when they talk, and especially for the Fed governors. And we're also going to be looking at big earning starting. For example, a company like Tyson Food, a company also like Norwegian Cruises Line. So those are going to report on Monday. So pay attention to those report, guys. For Tuesday, we have PMI. It's a major economic wealth report. So we're going to be looking at that. Why does it matter? Is because it will. We also have job opening report coming on Tuesday. So that will show you hot job demand, economy strength, and data. So we want to make sure there's going to be a lot of data coming in this week, guys. If again, if you're into investing, you're going to make sure you are paying attention to those report, guys. This is not science fiction. That's when the rich people get you, because they read those report and take decision based on those things. Is that a science? You don't need to be a science nerds to understand them. You just got to see the basic, get engaged, stay on top of your report. And for example, on Thursday we have productivity data that's coming out, so definitely a weekly jobless claim. So all those data that's coming out this week will help investors understand where the labor market strength is. So definitely we want to pay attention to that. And the biggest day of the week will be next week, Friday. We have US job report, a non-farm payroll coming, unemployment rate, and average hourly earnings, wage inflation. All this gonna come on Friday. So definitely we want to pay attention a lot to the data that coming on Friday. Why does it matter? This is the number one market moving data release of the month for the month. So we want to see strong job, higher rate risk, a weak job, recession fear. So those are the indicators that we're going to be looking at for next week coming up. And now we're going to talk about, as usual, after we give you our insight from the past week and next week, we want to talk to you about the three best stock on our portfolio. Again, we share those stocks with you guys so you can, educate yourself, look at those stocks. If they're working for us, maybe they're working for you too. We're not gonna tell you, oh, Joe, go buy those stock. If you buy them at your own risk, guys. But this is the stock in our portfolio that's been working. You might want to get a look at them. And the top for this week, we have Syndic. The sticker is SNDK. It's up 16% this week. Syndic is a corporation, a American multinational semiconductor based in California. So definitely this is like based on the AI infrastructures and the AI stocks that going up. More Syndic models, AI semiconductors are making money, more their stock are going up. And another a company that did very well for us this past week is Microtechnology. The sticker is MU. It's up 6% this week. It's also another American multinational semiconductor company. They specialize in flash memory, solid state drive, computer data storage, etc. So you want to make sure, if you are looking at long-term investment, make sure you check those stock for us. It's Microtechnology. And lastly, the third stock for us is Apple. Apple stock up this past week 5%. And like I see, this past week, AI technology sector dominating the market, and that's why you see S&P 500 is up about like 25, eh, almost 27%. So as you can see, there are money to make in the market if you stay disciplined. Don't panic. The goal is to always focus. And this past week, most of the upside in the market was dominated, like I say, by AI tech sector. AI story is still out there, guys. Don't be afraid. You got to go, and if it's the AI mark that's giving you the benefits, you might as well just get in and take it. All right. So now we shifting gear right now. We're gonna go deep on the topic today is bond investing. Most people think investing equal only stock, but the wealthy they use something way more stable generating income to generate income, which is bond. A lot of those wealthy people, when they get older, they start stacking on bonds because they want less trouble, even if it's less money in term of short term, but long term they still think bond investing is a great way to diversify your portfolio. So what if I told you there are way to get paid consistently even when the stock market is crashing? Today, I'm going to break down what are bonds, how they actually make you money, and how you can start investing in them even as a beginner. So stay until the end because I will show you exactly how to buy your first bond step by step. So type bond in the chart if you want to learn how to make passive income safely. So definitely, we want to make sure people are taking advantage of bond investing. Actually, in our portfolio, we start investing in bond. It's about like we can say about 30% of our portfolio is made of bond, but 70% right now is on stock. So we're trying to shift more into bond because of the volatility in the market. So definitely this is a good series for me also to learn. So if it's somebody out there who have a lot of bond exposure who also want to share with me what type of bond they buying, definitely let me know. Okay, so now let's see. Oh, what are bonds? Let's simplify it. Bonds are basically a loan. You lend money, someone pay you interest. That someone can be a government, company, a city, municipal, for example, municipal bond. So instead of borrowing money, you become the bank. So definitely that's a simple concept. For example, you lend $1,000 to a company, they promise you to pay you 5% per year, return you $1,000 in 5 years. So that's not only they want to pay you interest, but also they return you that $1,000. So how bond make money? Bond make you money in two ways, in two specific ways in general. So the interest payment, which is called the coupon, you get paid regularly. It could be monthly, quarterly, or yearly. So that depends on the condition of that payment. It could be monthly, quarterly, or yearly. And the second way bond make you money is price appreciation. Because guess what? In the middle of it, you can sell the bond for more than you paid. So that's also a good option. So the simple formula would be the bond income equal coupon payment and price changes. So the key is this is what I didn't understand at the beginning is like the price of the bond can go up and down, but if you keep it at maturity, that price that you buy, that's the price. That price doesn't change. Even though the market changed the price, let's say, for example, if today you buy a bond, you say after 10 years, I'm going to get my money back. That price you buy it today, if you keep it for 10 years, that's the price you guarantee you're going to get if they pay you back that money. Because sometimes they don't pay you that money. So I didn't understand that concept, but the change in prices, like the bond prices, can go up and down. If you decide to sell it in the middle of it or before maturity, You can either have a high price or a lose money as to sell it as a discount. So that concept will probably go a little bit more deeper on it later on. So for most beginner, focus on steady income. That's why bonds are popular. You have to think about the price changing, meaning there are risks still involved, and bond, when you're trying to get involved in the bond, you got to understand, even though they are safer than stock, bonds are still not 100% safe, but safer than stock in some regard. So now let's look at the different type of bond. Not all bonds are the same. Here are the main one. So the main bonds I can think of is like three type. Okay, we have the government bond. All right, so they are very safer. They have lower return. For example, the U.S. Treasury bond. If you're an American, you're looking for a safer bond investing. I will say the U.S. Treasury bond is a safer bond because the government, in in a lot of ways, the government can just print money if they run out of money to pay their debt. So it's almost a safer way to invest when it comes to investing in government bonds. And the second type of bonds that I'm thinking of, especially me personally, I would recommend for beginner investor is what we call the corporate bonds. A corporate bonds, which is ETF. If you look at corporate bond, they have higher return, more risk, but you're lending to company instead of the government. So definitely the corporate bonds, it could be a very safer way if you're looking at more diversified exposure to bond when you buy ETF, corporate ETF. And the third type of bond is municipal bond, usually issued by cities. Often they provide some tax advantages. They might give you some tax deduction from from the interest you're getting. They usually, you know, very in a sense safer a option when it comes to bond. And also you got when you look at bonds, you also have to consider when we come talk to about yield. There's some bonds can be there's quality and there is the yield. If a bond give you high risk, usually it's bad quality and it will have higher interest. Higher interest, poor quality, but higher risk. So that's why they get you. So that's the main thing. So would you rather be safe or go higher return? So think about it. Type safe or risk. So that's a very key concept that we're gonna talk about. Risk of bond. So we go deep now into talking about the risk of bond. So bond are safer than auction, like I say, but it's not risk free. So if you look at bond, you look at interest rate risk, for example. When interest rate goes up, the bond's price will go down. So if a bond is people are buying it, it's like supply and demand. If a lot of people are buying it, the bond, that means it's attractive. Guess what they're gonna do? They're gonna lower the interest rate. So you got high quality, lower interest rate. But now, if you have a perception that it's become not interested, the bond is not good quality, guess what? In order to attract people to buy it with higher risk, they're gonna have to put the interest rate up. So that means they're gonna have to give you more money for taking a higher risk. But also there is what we call the credit risk in bond. That's when your borrower might not pay you back. So if you are looking at a crappy bond and then you think, oh, because they give me good interest, and then that person default, guess what? You're done. They're not going to be paying you back. So that's why not everybody who's giving you a good rate, a higher rate, is a good investment. Also, bonds are not immune to inflation risk. Even though it's safer than stock, but bonds also are exposed to inflation risk because if inflation is high, your money will lose value. So you will not gonna be, even when you come back, you get your bond, the interest you get from the bond due to inflation is gonna lose value. So definitely bond is not inflation proof free. So this is why smart investors mix bond and stock, because at the end of the day, there is not a one single investment that's really the secret sauce. And investing diversification it is, but not just one type of investment. So now, how to invest in bonds? Let's get start practical. For example, the first one, you can try to buy as an individual. You can use brokers. You can do, for example, Fidelity, Vanguard. They might have like their own bonds, But as an individual, if you're a beginner, I wouldn't encourage you to invest in individual bonds because it requires some good knowledge. But what you can do is a second type of option for you to invest in bond is, like I mentioned before, which is the bond ETF. Especially, I encourage it for beginners. If you're not well knowledgeable on what you're doing yet, you don't have that experience yet of picking a good quality of bond, your best diversified strategy will be buying an ETF bond where you're exposed to multiple one. In case one goes bad, the other worst can help you. So it's a easier way to invest. Start investing in bond. For example, total bond market fund, corporate bond ETF. Those are like safer option for people who are investing, guys. Again, we're not trying to tell you this is not the hype telling you, oh, because this bond is going up, let's go buy it. No, you want to make sure you expose yourself to the smart way to do it and prevent you to lose money. And that's why this says about. It's not just we telling you, hey, this is how we make money, but we're also sharing with you how you can definitely protect your asset. So again, we mentioned already another way to invest in bond is through the treasury bond, especially for US. You can go online and go to the treasurydirect.gov and you can buy directly from the US government. So now, a concept that's very important when it comes to bond investing that you want to understand is bond yield. Bond yield, it's a very important concept because that's how you get the interest in how much your bond you're gonna generate. That's a very key formula to understand. A bond yield formula is used to measure the return on investors earns from holding a bond. The most common version of yield is the current yield, which compare the bond's annual income to its market price at that moment. So the current yield is the annual coupon payment over the market price of the bond. So in simple terms, it tells you how much income you are earning relative to what you pay for the bond. If the bond price drop, the yield will go up. If the price rise, the yield will go down. And for more complete measure, investors use what we call the yield to maturity, YTM, which include itself, it's a more detailed, more sophisticated way to calculate your return, which include interest payment, price to maturity, any gain or loss if held until the bond mature. Because that's a very key concept, guys, because the yield to maturity is not the same to the current yield. So for the yield to maturity, it includes, like I said, all the payment, investment payment, the coupon, the difference between what you pay and the bond face value, the time remaining until the maturity. Think of it as the true annual return of a bond, assuming you keep it to the end and reinvest it at the same rate. So definitely those are concepts that you really need to invest in, guys. The yield to maturity. Again, the maturity is the time when the bond, the time you're supposed to, that's the contract, in your contract, that's the time you will get your money back, your principals, and also all your interest and everything. So make sure you understand those concepts, guys. So now strategy. When it comes to strategy, how smart investor will use bond. So definitely, as far as strategy for bond, I will say it's one of the best diversification. If you're getting older, if you want to be a little bit safer, you're not taking too much risk, definitely it's reduce risk in your portfolio. And also, some people will use it as an income strategy. Some people will think about living off their interest payment. Depend. Now, if your bond is doing well, you do the right thing, you can live off some interest payment, you know. But I know right now it's very difficult, but some people still can do that. And also, you can use it as market protection. Like I said, when stock fall, guess what? Bond can stabilize your money. For example, myself, at Combi Group, we have a portfolio where we have 70% stock and 30% bond. But due to uncertainty in the market, as we mentioned, we're gonna looking at to create our portfolio maybe 50% stock, 50% bond in the next this year, just to avoid too much risk in the market. Because it's very, very important, guys, to know how to manage your risk when it comes to bond investing. So now, bond investing secret: why high yield can destroy your return. So again, we have touched on it. So now I want to go deeper. So why high yield can destroy your return? Most people think higher yield. When you look at a bond, higher yield equal more money. And that's one of the most expensive mistake of investing. I'm gonna repeat it again. Most people think higher yield equal more money, and that's one of the most expensive mistake in investing. So think about it. If would you rather earn 8% and 5% of interest, then what if the 8% actual lose you money? Why? Because you invest in a bad bond. The bond that you invest in is not good quality. So that's why not everything that cheap, it's a good investment. So always think about quality. The quality of the bonds you buying is very important. So in simple term, think yield as income, right? It's interest payment, and the total return is a combination of income, price changes, and efforts. So definitely you got to understand the yield is just income, but the total return is what we're concerned about as investors. We're not just looking for the yield. So let's say if bond A is giving, like as an example, if bond A is giving you 80%, 8% yield, and therefore, guess what? You will lose your principal. But compared to a bond B was giving you 5% yield but is stable, you will keep earning and price stability. So just because you have higher yield, that doesn't mean you're not gonna lose money. So that's very concept. That's where the risk management come. Those actual concept. So the most important thing is a high yield bond can actually give you a negative total return when you at the end. When it's time for maturity. So make sure you pay attention to that, guys. So that's what they call in the bond a community. They call it full yield segment. This is what they call, again, full yield, because high yield, but you got a worse return. So high yield often equal to higher risk, because they're trying to lure you on getting something bad for taking more risk. They reward you for that. So the risk of that is because you're getting exposed to more risk. There is a risk to default. There's a risk that the company you're buying bond from, go to debt and go bankruptcy. So in case of default, You may not even get your interest there payment. So this can go very bad, guys. So that's why I would suggest go look for higher quality bond instead of just yield. So now we're gonna go into a concept called credit rating. So credit rating, because when you look at the quality of the bond now we have talked about yield. Now we're gonna talk about the quality of the bond, and that's why when we talk about the quality of the bond, it's about the rating, credit rating. This is where investors focus. Rating are basically algorithm predicting will this company survive or is it gonna default. So most of the investors that we in the market, we look at what we call the Moody scale. This is the scales that most of the investors use. It use a rating 3A, a letter grade. It goes from AAA to C grade. So on AA, triple A, they call it. It's a faster, it is safer, but zero default. So those company, they are like safer because they haven't default yet. They have been paying people. And you have triple B. They are lower investment grade, but still not bad, you know. And also you got double B, which high end junk. It's still decent quality, but it's like it's still not good, but neither bad. So then when you look at the B and CC grade, those are bad, you know. So the C grade definitely the C grade bonds. I'm not looking at them myself personally because I'm not willing to take that risk. Even if the yield is good, I'm not taking no risk. So that's why on our portfolio at Combi Group, we are very systematic when it comes to bond we buying. We do our research and we stay with quality, guys, over price. Quality over price. Remember that. I repeat, when it comes to bond investment, it's quality over price. The yield is the reward, but the rating tell you your risk, you know. So that's very important. So before you buy a bond, make sure you check the Moody skills, guys, of the bond and do your investigation. And it tell you when you look at the Moody scale, you will understand default risk, you know, because AA bond, for example, you can ensure that there is zero default over the 5 years. But a C bond, you can have almost like 34% default, only 11% that those bond become upgraded. Because every certain time, those company will do a lot of investigation, talk to the companies, analyze them, and give them an upgrade, right? So you are more likely to lose money than get saved by an upgrade. So that's why when you look at those information, you really understand like if you're in a bad situation already when it comes to bond, your upgrade usually is probably going down. So that's why you stay with quality, guys. And in general, how do they build those rating? They, the key metrics they use in this company is EBIT. No, they use it 33%. Again, earning before interest and taxes. We talk about those concepts already at the beginning of this series, guys. We are not gonna go on and explain them again, but go back again. If you haven't been paying attention, this is your chance, guys. Go back online and check, make sure you are doing go back to understand those concepts. You got EBIT over interest. It tell you can the company pay interest, and also they look at a debt over EBITDA. So it tell you how healthy is the debt load. So those are the mostly the things that they consider when it comes to doing those rating. So rating is are basically an algorithm predicting will the company survive or default. So before you invest, that's a very important question. That's a $1 million question you need to really understand before you invest in those bonds. So for smart bond strategy, you wanna focus on quality. I will suggest the treasury bond. it's not risk free, but basically, the government will can have the option to print money to pay his debt. We talk about the triple B corporate bond. Those are the bonds that we in Common Group we like, because those are the bonds that we invest in mostly, because what they provide is a balance of risk and reward. So definitely we want to be in that category. So what you don't want to do is chasing yield blindly. Don't just see like, oh, they give you like a 20% return, but after 2 3 months the company go bankrupt and you don't have no money, neither your interest. So don't ignore credit risk, guys. Make sure you focus on bond being upgraded, because every time the bond is being upgraded, you're taking advantage, you're buying more when it's positive. Look at also if they're improving their financials. So, and also look at any mispriced risk. Maybe sometime, the company is not that bad based on the financial and they give it a bad grade. So definitely you want to pay attention to that. All right, so now we want to talk about one concept that I want to talk about is as how bond and stock, the relationship between bond and stock, because that's very important. Usually an invest in a relationship, there is an invest relationship between the bond prices and the stock prices. So when bonds price goes up, stock prices often go down, and when bonds price go down, stock often goes up. So why? Because mostly it's based on interest rate. So interest rate weight a lot on how those relationship between bond and stock develop in the market. And interest rate are like the bridges rate, So bond yield goes up, borrowing get expensive. So that's the key, guys. If bond yield goes up, borrowing get expensive for the government. So the stock will fall. The companies or the government, whoever it is, will earn less. So it will do valuation will drop, because they have too much debt. They take in more debt because they have to pay more. It's taking away from their profit. So now, if the interest rate go down, bond yield will go up, and borrowing get cheaper, and stock rises, go improve, valuation increases. So again, pay attention, understand this interest rate relationship that's kind of between the stock and the bond. So that's why when you're looking at those financials report or on TV, when they talk about stock, you see that relationship when it comes to interest rate. So how interest rate goes up and down and affecting either bond or it affect also the stock. All right. So lastly, we have a concept that we want to touch base on. You will hear it a lot, and that's a very important concept to understand. As investors, you might hear about bond vigilantes, how they control the market. So you think like, there is a group of investors, guys. They call them the bond vigilantes. What do? They are investors in the bond market who discipline government and central bank. How they do it? By selling bond when they believe fiscal or monetary policy is becoming too risky, especially due to rising inflation or excessive debt. So the key mechanism is bond price goes down, yield goes up. So that concept is very important, and we will see that when they sell the bonds, right? So let's say like the government is acting up, and we have seen it through a lot of examples this through histories. When they don't agree with the government, or the government is doing something they don't like, guess what they do? They dump the bonds, they sell them. So the bond price fell. So they liquidated it. The bond price fell and the yield rise. So that means now, to attract more investors, the government have to raise their interest to pay. So they have to pay more for people to buy to attract more investors. So that will create pressure on the government or central bank, because higher borrowing costs and can slow the economy and increase debt burden for the government or the institution that giving the debt. So higher yield mean higher borrowing costs, and government must pay more interest on new debt. So that's not good for the government, guys. So what happen is also mortgage rate will rises and business loan get more expensive. So in this case, what we seeing is having them selling the stock. What is saying is signals inflation fear. If investors expect higher inflation, they don't bond, pushing yield up. Stock will fail. Also, another way they control the market is by forcing policy changes. Raising yield can push government to cut spending or central bank to tighten monetary policies, like raising interest rate, less aggressive and more careful. Another way they control is the impact of all assets. So higher bond yield often makes stock less attractive, tightening financial conduction across the entire market. And also, it can act as a feedback mechanism. They don't set policies directly, but they influence it by creating by reacting quickly to understandable economical decision. So as you can see, guys, the bond vigilantes are very important investment, a group in the market. Actually, they say they are control. Those are the group that the government, the central bankers, those are the one they fear. And I'm gonna give you a quick example. For example, two examples. You see in 2022, I don't know if you remember, there's a crisis in the UK after the UK announced aggressive tax cut, and they didn't like that. Investors lost confidence. The bond yield, guess what? Surged. So what the government had to do, they have to reverse cost policy quickly. That's born vigilantes in action. I remember exactly this guy was coming was gonna go do all those changes, but guess what? The government have to deal with the bond vigilantes was dumping stock and make them pay more money for to borrow money, so they have to reverse costs. And last year, I remember with Trump tariff agenda last year when he was throwing tariff all over the place. For example, I understand the U.S. bond vigilantes, especially government like Taiwan, Japan, they are heavily investing in bond in the U.S. What did they do? Trump was taxing them. They start dropping, dumping the bonds, U.S. Treasury bond. So since they own a lot of that bonds, and when they start giving them away, the interest rate for those bonds will go up, and the government didn't have any choice to reverse costs. And that's why you see Trump, he even say he was worried because when he see all the bonds, people start panicking. And I think that was a big lesson to tell you, you got to pay attention to the bond vigilantes. The stock market is really well controlled by those people. So I know that bond investing is not attractive investment in general. They usually say it's for old people, and no, because those are very powerful people. So if you are like in that position, you want to be in position and power. So why they matter to you, even if you don't buy bonds, their action, they can impact the market. Stock can fall when yield rise, like we mentioned. Mortgage rate will go up. The credit become more expensive. Your investment become more volatile. So that's the impact of the bond vigilance in the market, guys. So definitely, I didn't understand that concept of bond vigilance, and now seeing it, especially the last year of tariff, the beginning of the Trump administration, how the government had to back down on their increasing their hike on taxes on some government, because why? Because the government were dumping their stock, and I saw this concept play out like textbook. The way I was learning about it, it was amazing to really see it in practice. So definitely, make sure you understand this concept. I know, in general, when you look at the market, guys, don't just like picking things. Make sure you understand the concept and what you're doing. And this is where financial education is so critical, but it requires time. A lot of people just want a secret sauce. We don't have secret sauce here. We tell you it's a lot of work, and that's why rich people they get richer because they put the work. And a lot of people, if you don't, I can tell you, if you don't put the work, guys, if you don't put the work, you're not gonna get to the next level because it's required a lot. Like me, for example, every single day I have to wake up early, 6, 7 a.m., that is 5 a.m., 6 a.m., to really look at what's the market, get those information, understand what's going on. So I encourage you to really stay invested, stay committed to your knowledge, guys. So, like I say, the bond vigilancy, they don't have official power, but their influence, they can influence market. So, investors, their action will impact the government, the way they borrow money, and investors decide the cost of what borrowing. No buyers, no cheap debt. So, definitely, this is like a concept that we want to leave you with today. So, now you understand something most beginner ignore. The bond equal stability plus income. If you want to build real wealth, you don't just chase growth, you protect it. And again, having bond investment strategies will help you secure your investment. So follow me for more investment breakdowns. Share this live with someone you need to learn more about this topic, and more topic is coming. We will be live on Sunday the 10th, next Sunday. We will talk about crypto investing, and after that, we will go deep into a liquid asset like real estate, art investment, and a lot of other type of a liquid asset investment. Like I said, this was a very, I know it's a lot of information, but guess what? It's worth it. It's worth sharing those information out there so people can equip with the information they need to take their investment to the next level. So without further ado, I will say have a good week. Stay focused, stay investing, and I'll see you next Sunday. Ciao.